Hey, my name is Rajesh. I am a direct lender in Los Angeles, specializing in 2 to 8 unit multifamily buildings. I'm also a multifamily building investor myself, and today we're going to be looking at a 6 unit in Los Angeles, 4071 Melrose Avenue. These photos look nice, and it seems like all 6 units have been fully renovated. Let's see what this place earns. Looks like it's, well, I don't know if it's blocked off. Zoning is residential 1.5. Opportunity zone, so you get some special tax credits. But I'm just going to be looking at what it would take to make this qualify for a loan. What's the minimum down payment you would need? And in order to hit the numbers that you need to make this thing get approved for a loan, as well as what it would take to actually cash flow. Whether it's a good investment or not, I don't know. But let's see here. We got 5 units earning $2609. 2609 times 5 plus 3,000. So that means gross rents are $1645. And the price is $2.35 million. 2.35. 0 vacancies. Gross rents are $16,045. And let's see, property taxes are handled. This is 6 units, so you're looking at probably $6,600 a month. Water, gas, electric, bare minimum. Property management. Let's say you're not doing any property management, that you're self-managing. Okay. Maintenance is at 10%, $1,605, but let's say it's $802, 50% of that. We're going to be very generous here. Right? Let's say you're a real go-getter and you know how to manage this property better than anybody else. So at a 1.0 DSCR ratio, right now we're seeing rates at about 8.25%. And that's a 1.0 DSCR ratio. To hit that, you're actually losing $1,500 a month. You would get approved for this loan, but the operating expenses itself make this mean that you'd be paying $1,500 a month out of pocket for the pleasure of just owning the building. And that's with a down payment of $613,000. Now, on the flip side, that's a 26% down payment, by the way. But on the flip side, if you go to something like Chase Bank and they're like, oh yeah, we'll give you a 5.875% loan. Let's see what that looks like. You've got to hit a 1.2% rate DSCR ratio at minimum based on NOI, or net operating income, which is your gross rents minus all your operating expenses. And that leaves you with net operating thousand of $11,000, $11,500, and you're like, that's fantastic. But the loan, even at 5.875, is $9,600 a month, which means you are left with $2,000 a month, roughly. So 1.2 right here. Yeah, roughly $1,900 a month, $2,000 a month. Your down payment is $726,000, but you're cash flowing to $2,000 a month. Now, if we were to go DSCR loan and interest only, in order to get that same sort of cash flow, and you can go interest only on Chase Bank loans and other bank loans and agency loans for a period of 5 to 10 years. But the other thing they don't tell you is that with these bank loans is that it comes with a prepaid penalty of 5 to 10 years, 5, 7, and 10. Some come with 3-year prepayment penalties, which means you're not allowed to refinance without paying a penalty of the remaining balance. And if you're doing interest-only loan, that means your entire balance is everything, the purchase price minus the down payment. With the DSCR loan, when I price these out, I put a 1-year prepayment penalty because one, you're getting the benefit of a lower interest rate, and two, you're most likely not going to be refinancing before the year is up, just because it's going to take you about a year to stabilize. So let's see what that looks like. Interest only 5.875. It says 587. You're going to have to buy down the interest rate by 5 points just to get that much. So let's see here. Price was 2.35 million, I believe. 2.35 million. So 2.35 million minus 587,500. So you have a $1.76 million loan. Multiply that by 5 points or 5% of the loan amount. And that means you're paying $88,000 extra just to get that 5.875% interest rate. Whereas the bank loan, they're not going to charge you points to buy down the interest rate. That's their default rate. But let's see what that looks like if you're just thinking of this as an investor and this is just cash out of pocket. So you got $88,000 plus $587,500. That's $675,000 at minimum you have to come to closing with, and your cash flow is $2,900 a month, almost $3,000 a month. Whereas if we go here at 5.875, right, just to hit that 1.2 DSCR ratio, you're coming out already out of pocket $726,000. Even if you go interest only at this point, and we can do that right here, we can go 1.2 and see what that looks like. Well, if we go interest only, that's just what it looks like. So let's see what this one looks like if we were to go 1.38, right? Now you're getting $3,100 a month, about $200 more a month, but you're paying $937,000 out of pocket, whereas over here you were coming out $675. So this property is a good example of something that would qualify for a bank loan and a DSCR loan pretty easily, but where the DSCR loan might be a better fit because it's just less money out of pocket to get a hold of it, while still cash flowing roughly the same. So if you can pay less to get the same amount of return, that's probably a better deal. That's what my investor hat on. With the underwriter hat on, we can get this done at an 8.5% interest rate without changing anything. You're going to be losing money, but the property will get approved. And you're still coming about out of pocket roughly $653,000, $675,000. Of course, this does not include all the other costs of the loan, like the origination fees and the appraisal, the cost of the appraisal, things like that. And because this is a commercial property, your appraisal is going to be roughly $2,500. And because the loan amount is greater than $1.5 million, again, you're going to have to do 2 appraisals, not 1. Just because lenders and investors want to make sure that the building is worth what the appraiser says it is, because it's a huge loan amount. So they want to mitigate their risks as much as possible. Anyway, I hope that was educational.